Welcome to the second part of this video. Today we're going to talk about the regular bearish candlestick. And the regular bearish candlestick is very often represented by red candle body or the black. So if we look in the charts, we can always identify this kind of candles are always very common, right? So, well, of course, the length of these candles would be actually different from one another. But is the ratio of these shadows and the bodies could actually differ a little bit also as well. So you might see some of them have shorter wicks or shorter shadows compared to the body, and these ones have longer shadows compared to the body. But it doesn't matter. So what it really matters is that this is not more than 40%, around not more than 40% of the entire candle. So that means 40% means that this wick has to go up to around, yeah, something like this. So if it's like more than 40% means let's say more than 50%, which is somewhere around this, yeah, around this length, then we would not consider this as a regular bearish candle. Then this we will call a doji, which we will actually cover in other topics. All right. So, well, they're pretty common, and you can see they're quite frequently present in the charts. And here we can circle some of them. Some are smaller, some are bigger, and then they don't have really a balanced wick all the time, because in the original picture you can see that these wicks are quite balanced. You have like here more probably about 15% of the entire length of the candle. Here is another 15%, right? So some of these, like it can be longer in either side. So this is like probably about 25% of the body candle, and the one below is around maybe 12% of the entire body. I mean, of the entire length. Right. So now you get the idea. So if we look at this bearish candlestick, regular bearish candlestick, it starts off with an opening price, and let's say this is the entire day session. So let's say this is open, and then price goes up as the bulls are trying to bring the price up, and then they couldn't go any higher, and this is where the bears come in and they start to reject the price. So, and it fails to make the price upwards, then it goes down significantly, and this is where it cannot make even lower lows. Then there's some rejection of the price, and as the day ends, it closes above the low and but below the open, and this is where we call regular bearish candlestick. So if you look at the true, in the real example, so this is like this is actually a day session around 7 hours. So which starts around 9:30 and ends around 4:30. So you have a lot of candles within a candle, and what we can say here is that, okay, this is the opening price where you see the blue dotted lines are the starting time, and let's say, okay, the candle forms beginning with a line. Then after that, then you have a price going upwards, and it immediately gets rejected. All right, and that's where we call the high. So it couldn't go higher than that. Immediately it gets rejected, falling all the way down to, all right, the bottom right here. And right here, it couldn't actually do go even lower, and that's where it gets rejected by the bulls coming in strongly, but couldn't make it higher than the opening price. And here again, this is where we get to see a lot of bears are actually lining up here to actually trying to bring the price downwards. All right. So again here, then you have price rejection. So again, if you look at this candle right here, we don't always get balanced shadows and wicks. Like in this case, you have longer upper wick, lower, the shorter lower wick right here. So yep, that's one of the example, and I hope yep, Okay, this is closing price, and I hope you enjoyed this video, and thank you for watching. Happy trading and investing. Striker X signing out.